Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we welcome back Tim Ord, who's the president, editor, and publisher of the Ord Oracle. How are you today, Tim?
Good. Thanks for having me on. I'm looking forward to this conversation.
I know you like to track and analyze the price action for the GDX when looking at the miners, Tim. So it would be good to talk about why you track it from a technical perspective and which indicators are the most reliable for you when analyzing the GDX. And from your analysis, are we now in a sustained bullish trend for the first half of 2020 for the miners?
Yeah, actually, as far as seasonality goes, this is an election year for the U.S., United States. And January is usually bullish seasonality-wise all through January and actually part of February. So gold, that's for gold and gold stocks. So we should have a pretty decent month this month, probably into February. But February, a lot of times seasonality is some sort of a high. But between now and the next month and a half, it should be pretty good. The indicators I really like to use to really keep me in the trend, one is the Bullish percent index for the gold miners index. Bullish percent index is an indicator that measures the percent of stocks that are on point and figure buy signals in that index. And I usually take a 10-day average of the Bullish percent index to kind of smooth out all the bumps. And when that indicator is above 40%, in other words, 40% of the stocks in that index is on a buy signal, I'm using the gold miners index. I think there's around 60 stocks in that. Well, anyhow, 40% of those stocks remain on a buy signal. Usually, the uptrend will continue. And right now, we're in the 80s. I didn't look today, but I think yesterday was around 82% of the stocks in the gold miners index on a 10-day average is 82%. So you got a lot of stocks and an uptrend in the gold miners index, suggesting this, even though we've been going through a consolidation over here for about the last month, the breakout should be to the upside here because the index is still real strong. Another indicator, or actually two indicators that I like to use to really keep me in the trend, is the 50-day average of the up-down volume percent for the GDX and advanced decline percent of GDX, and I take 50-day average of those. And when they're above zero, which they are now, the uptrend's intact. So we don't think the trend's done yet. How high is high? If you notice, GDX, we're bouncing against the previous highs of 2016 near 31, and we're just hovering right below that, like 29.5. And we're a little over 29 right now. And we're kind of building just a trading range right below that breakout area. And I think what the market's building here is some energy to break through that 31 area. And if we do get 31 through 31, the next upside target is the previous lows of 2012. And that comes in around 37.5 area. And I think that's probably where we're heading by mid-February, give or take. So it looks pretty good, even though there's some indicators that not really matching up to this rally. One of them is GDX-GLD ratio. All that does is when this ratio is rising, it suggests that gold stocks are outperforming gold. And that's usually what happens in a bull market. Gold stocks outperform gold. In bear markets, the gold outperforms GDX. The intermediate term trend remains up. The short term trend sideways. So, but everything looks pretty good. Even though we had a decent rally here, end of December into the first part of January here, we think we got quite a ways to go yet.
Well, I was just going to ask you about when markets are very overbought, what indicators do you like to use then? Do you like to use something like the RSI? And do you use this to sell or trim a position or take partial profits? How do you determine when to sell an instrument or a stock?
Actually, this is an indicator we're watching right now. It has really been, for intermediate term tops, is it's a slow stochastics, the monthly slow stochastics of the XAU gold ratio. And when this gets up around 90%, it has picked out all the intermediate term rallies going back to 1980. And this indicator right now is in, I don't have it right in front of me, but it's right around 80. But it's a monthly chart. So it gets up around 90, which I think if GDX does get to say up to the next resistance, which is around 37, 38 range, most likely the monthly slow stochastics of the XAU gold ratio will be probably up around 90. And that will indicate that probably to us, that'll be an intermediate term high of some sort. An intermediate term high, I'm talking about not a long-term top, but a multi-month consolidation. So I think it would at least be a 2, maybe even a 6-month consolidation. And that's what I'm thinking what we're heading for here is a multi-month high sometime in February, possibly around 37 area on GDX. And the market may consolidate all the way into maybe next September of this year. So it's not a long-term sell signal, but it would be a larger consolidation. But the bull market hasn't ended. It's just going to consolidate for the next major leg up that may be taken force sometime later this year. So that's what we're looking on. We've been long since January 29th of 2019, and that leg up is probably going to end in February 2020. So that was a year, year and a little over a year run in GDX. So it needs a consolidation period to absorb some energy for the next major leg up. So, but that's what we're looking for. So this next high, I think we'll probably most likely will step out and go back to the sidelines and wait for the next low. So it won't, since this is be a more of an intermediate term high, we won't pay attention to the RSI. We'll actually look at the slow stochastics of the XAU gold ratio getting up around 90. So that's our BRQ to exit.
And I would like to point out that we're currently recording this on the 7th of January. You suggested in our earlier interview back in August last year that we are at the beginning of a new 3-year cycle for gold. So in your view, we're still on track, but is there anything in your mind that could change this outlook? Is there anything that could derail this bull market? Or in your view, are there just too many potential indicators coming together or too many catalysts that are now here to make gold go higher?
Well, you got seasonality. You got a 16-year cycle and an 8-year cycle. That's not due until a high around, I think it's 2023. That cycle works just, we got 2, maybe 3 years to go yet. This impulse wave up looks to us in a 5 count. If we do get to around 37 area, that will reinforce that we did have an Elliott wave 5 count up from a low. So that bodes well. Momentum is trumps everything. And right now, momentum on the monthly charts are up. And it could get, extended sometime in that 2022-23 range. But I think we're basically fine between now and then. So what could derail the market? I guess if the bullish percent index for the gold miners index on a monthly time frame on a 10-day average got below 40 would worry us. We're far from that. That would have the market really get beat up here in the next 6 months. We don't think that's going to happen. We think the next consolidation, in our opinion, be pretty mild, more of a sideways pattern than a big pullback. So I think in general, we're pretty clear sailing for another 2, maybe 3 years. So after that, we'll have to be talking what leads up next. So, but between now and then, I think that trend's up.
Excellent. Okay, well, let's move on and talk a little bit about your past history within the markets. Back back in the 80s and 90s, would you suggest that it was easier to trade or to invest back then? Or has it always been difficult to pick out turning points or new trends within a market? And have you found it easier as you've gotten older?
Yeah, actually, we'll take the last question first. It's getting easier, getting older. I guess when I was younger, I was hate to say that, but when you're young, you're kind of dumb. You learn from experience and slaps the side of the face or side of the head. Kind of teaches some life lessons along the way, and I had a few of those. So as you get older, you quit making those stupid mistakes, and you become more disciplined, I guess. And you don't necessarily shoot from the hip like I used to. So things, and you understand which ones work, what indicators work better as you go through time, become less panicky when you're at major lows or major highs, or major lows or euphoric at highs and stuff. So, yeah, it gets easier. There's a lot more information there, but nothing's really changed a whole lot. You know, has it been easier? At the beginning, when I first started trading, actually I had a few indicators, and I just relied on those indicators and did nothing else and did fine. As more indicators, as the internet grew and more information became available, things got a lot more complicated. But if you went back and just did your old indicators, you would have been fine through all that mess. As there's more competition in the market, but really nothing's really changed. You know, the markets of the 1930s and the 1990s and the 2020s are all basically the same. There's no magic indicator that is right all the time. The ones that worked back in the 30s still work now in the 2020s, and they work just as well. So as you grow older, I guess you get a more understanding of how the market really functions. So, and you become more common and confident in your abilities, I think.
Okay. Well, for the rest of 2020 then, are there any other commodities that you're looking at? I know you're bullish on gold, silver, and the junior miners, but are there any other markets you're paying attention to, for example, copper or nickel?
Yeah, actually all the metals and actually all the commodities, you know, wheat, corn, all these commodities I think are going to come to the forefront. And actually, as far as the U.S. market is concerned, the S&P, Standard & Poor's, actually still look good this year too. The gold market outperformed, and the metals and the commodities outperformed the S&Ps. I think they will. For some reason, there's a lot of these commodities are going to come to the forefront. So, and they've been kind of dead over the last couple of years. And I think the cycle work suggests that these markets, copper, palladium, palladium, and all those metals are coming to the forefront now. So I think most of those will continue to rally. So it's going to be a commodity-based worldwide. These commodities are going to come back in vogue again. So why is that happening? Don't know, but the charts are looking pretty good. Their momentum rules all of the indicators. If it's going up, doesn't matter what indicators say they're overbought or whatever. If momentum's up, then the market should go up. And I notice on the monthly charts, the commodities are all turning bullish here.
As we begin to wrap up, Tim, is there anything else you'd like to share with our listeners today? Anything else on your mind?
You know, worldwide, I think commodity markets are all looking good. Gold and silver. Silver hasn't really performed yet, but it should start getting going here. Don't know when. It could be the next cycle, which could be later this year. But silver still looks good long term. But gold, I think in February sometime there could be a high in gold, but not a major high, just an intermediate term high. And we plan to, if that is a high, there'll probably be some sort of a low later this year, probably sometime in September. So, but over the next 3 years, gold should really do well. How high is high? I hate to give projections, but there's a real good chance we'll at least break the old highs, which is up around 1900. And how much higher than that, I don't know. let's wait and see as time marches forward here. So.
Okay, excellent. Well, many thanks again for your time today, Tim. We always love having you on the show.
So thank you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?